Hey everyone, welcome back to Corporate Decoder. Today we're cracking open the filing for the Calamos Aksia Private Equity and Alternatives Fund. It sounds complicated, but don't worry, we'll break it down simply. I wouldn't want this to be a private equity firm for my brain, impossible to access. First, a hook. This is a brand new fund aiming for long-term growth by investing in private equity and alternative assets. Think of it as a fund of funds meets Wall Street, but remember this isn't your typical stock. It's got limited liquidity, so you can't just sell it whenever you want. We're going to dissect how they plan to make money, what risks they face, and whether it's something you should be considering for your portfolio. And before we dive in, if you are enjoying these decoded insights, please subscribe to the channel and join our Discord server that's linked in the description below. Alright, this document comes to us straight from June 6, 2025. It's their registration statement, basically their official introduction to the SEC and potential investors. We're looking at Amendment number 1. So this isn't their first attempt. They're aiming to continuously offer shares, so this isn't a one-time deal. They're offering 4 classes of shares, Class A, C, I, and M. Think of it like different tiers with different fee structures and access. The stated goal is long-term capital appreciation, growing your money over time. They are going to make money by investing in stuff that most people can't. So what exactly are they investing in? Well, at least 80% of their money will go into private equity investments and alternative investments, and alternative investments is a mix. They include investments in private equity funds with many different strategies like buyout, growth equity, and venture capital secondary investment. Those are like buying someone else's private equity investments and direct investments directly in non-public companies. Alternative investments is a catch-all term for assets outside the usual stocks and bonds. This includes complicated derivative strategies using options, but also investments in publicly listed companies that are in the private equity business. Here's the catch. This is an interval fund. Every 6 months, they'll offer to buy back only between 5% and 25% of outstanding shares at the then current net asset value, or ENV. While normal, they expect to repurchase only 5% of shares on a semi-annual basis. That means you might not get your money out when you want it. This is for long-term investors, not traders. Think carefully before you invest because your money could be locked up. Let's dive into what it'll cost you to be involved. This section spells out all the fees and expenses, which is crucial for understanding your potential returns. This part is what Warren Buffett would do. For Class A shares, there's a maximum sales load, like a commission of 3.5% right off the bat. Class C, I, and M shares don't have this front-end sales load, but Class C has a potential exit fee, but Class M shares have no sales loads. But the financial firms you are investing with might. The management fee, what Calamos charges for running the fund, is 1.75% annually, taken from the average daily net assets. For every $10 started dollar interest expense of 0 or 1 fund expense is 3.85%, $4.60 A, C, I, and M shares respectively. But wait, they have a fee waiver in place that lowers the percentage by 1%, which has the result of making classes A, C, I, and M shares cost 2.85%, 3.60%, 2.60%, and 3.35%. So for the first year, your expense looks better, but the waivers can go away. Class A has a smaller servicing fee, 0.25 rent, C has 1%, and M has 0.75%. This fee compensates financial professionals. The more expensive it is, the worse it is for you. Because they will be investing in other funds, there are extra acquired fund fees and expenses of 0.70%. Keep in mind that these numbers are estimates. The real expense may be much higher. Here's an example of how it all adds up, assuming a 5% annual return. A return they are in no way promising. After 10 years on Class A shares, you have paid $458. Look at Class I, which only has a $373 cost. If you invest a lot of money, the best choice by far is Class I. Also, if you happen to sell your Class C investment, they get an extra 1%. Okay, let's break down the strategy and where they're going to try and make money. The fund aims for long-term capital appreciation, not quick profits. They're diving headfirst into private equity investments and alternative investments. Now the sub-advisor will try to spread the investments across different managers, investment types, strategies, industries, and locations. The identity and number of private equity investments will change over time as new opportunities arise and existing ones finish. No assurance that it will represent either a diversified or a representative group of strategies. They're primarily targeting North America and Europe, with a sprinkle of developed and emerging markets. Also, expect to see them investing in industries like tech, healthcare, industrials, and consumer goods. Now, here's where things get spicy leverage. The fund plans to borrow money to boost its returns. Specifically, the fund expects to incur indebtedness in an amount not to exceed 33.13% of its NAV. Debt can magnify gains, but it can also magnify losses. The amount of expenses will increase, but also your profits if things go well. Time for the fine print, the risk factors. This is where they tell you everything that could go wrong, so pay attention. They clearly outline that there is a long list of different things that can go wrong, so you might want to see a professional advisor. First, the big one, the shares aren't listed on any exchange. That means you can only sell them back to the fund during those limited repurchase offers. This isn't a liquid investment, which can be very, very bad. They expect to hold investments that are not easy to sell. They also state that the value of these investments may be difficult to value. Also mention that illiquid securities are subject to wide spreads, meaning the price people will pay is volatile. We already know that they plan to borrow money. Using debt can accelerate losses if they can't refinance their debt, or if interest rates go up, the fund's returns could suffer. They illustrate the effects of leverage with a table. If the portfolio returns 10%, the shareholder's total return is 9.61%. But if the portfolio loses 10%, the shareholder loses 10%, the shareholder loses 10.39%. It cuts both ways. While it assumes borrowing represents approximately 5% of assets, and you might be wondering why so little. As a RIC, the fund has to be very careful and meet requirements, for example, asset diversification. If they don't, they could have to dump investments very quickly and suddenly at a potentially bad price. This is difficult because private equity investments are not very transparent, making it difficult for the advisors to check if everything is all right with the books. The fund depends on key people at Calamos and Aksia, and their departure could hurt the fund. They also may need to hire new investment professionals, and not being able to find those investment professionals would have a material adverse effect. Also, they say that the advisor and the sub-advisor have received exemptive relief from the SEC that permits the fund to participate in certain joint transactions that otherwise may be prohibited. However, there are also several conditions as such that could limit or restrict the fund's ability to participate. Lastly, shareholders may need to report if they own a lot of shares. It may get very complicated depending on how much you invest. You can't just freely transfer shares. You need the fund's consent. Also, you have to be eligible and transfer a meaningful amount of shares. They can't be small amounts or they won't be qualified and approved. The appendix contains their policy on proxy voting, a technicality you probably won't have to worry about. Alright, let's step back and look at the big picture. This fund is aiming for solid long-term gains through a blend of private equity strategies. The management seems experienced and reputable, and those fee waivers help in the early years. However, high fees overall can eat into returns, the lack of liquidity is a huge red flag, and the use of leverage amplifies risk. Before investing in this, consider whether this is really a speculative bet. What do you think about this and the world of private equity? What are your thoughts on their planned 5% semi-annual repurchase offer and their approach to unlisted assets? Let me know in the comments. Don't forget to like and subscribe if you found this breakdown helpful. Also, check out our Discord channel for more of this content. Thanks for watching, and I'll see you in the next one.